Hi believers, this is Amit from Waya team, and I'm here to provide a weekly bite and the road ahead in the markets. The week was a turbulent one for our markets. Global factors led to a sharp down move, with both Nifty and Bank Nifty witnessing a weekly loss of 4%. And the broader markets, small and mid caps fell 2.5% and 3% respectively for the week. In our past few weekly bites, we communicated of maintaining a cautious approach. The monthly RSI for Nifty had reached 80 levels and in the overbought zone along with the declining breadth indicating weakness at higher levels. Let's analyze potential reason for this ongoing correction. Primary reason is China's unexpected fiscal stimulus that led to outflows from emerging markets like India. China introduced series of stimulus package to revive slowing economy. Key measures include cutting repo rate and freeing up of 1 trillion yuan for fresh lending to ailing sectors like real estate and banking. The rebound in Chinese market has led to further outflow of capital from various global markets due to its cheap and attractive valuations. Chinese stocks have largely gained 35% in just span of 2 weeks. Foreign portfolio investors have sold almost 41,720 crore in Indian market over the last 5 trading session itself. This flight of capital into China is a tactical move for global investors and might persist for a short period of time, acting as a headwind for domestic stocks. Second, geopolitical escalation in the Middle East led to sharp rise in oil prices, and it further contributed to the negative sentiment. Further escalation would add to the downside pressure in risky assets like stocks. With such significant global factors leading the market moves, it is unclear if SEBI's new regulatory norm for FNO had any impact on the markets. Technically, the immediate support for Nifty is placed around 24,550. On the higher side, immediate resistance are seen around 25,600. We expect markets to be very choppy. With the start of the earning season next week, stock specific action will continue. Also, the focus will remain on interest sensitive stock amidst the RBI policy meeting next week. Although rate cuts might not be on the table, commentary will hold great importance. Coming to the news from Indian economy, India's manufacturing activity eased to an 8-month low in September as rates of expansion in factory production and sales receded and the international orders rose at the slowest pace. The HSBC India Manufacturing Purchase Managers Index (PMI) stood at 56.5 in September, down from 57.5 in August. The report said a factor constraining growth during September was the softer increase in the new export orders, and the rate of expansion remained moderate due to global challenges. The goods and service tax (GST) collection in September slowed down to growth of 6.5% year on year and generated revenues of rupees 1,73,240 crore, about 1% lower than the August number. However, with the festival season ahead, collections are expected to be better in the coming months, so this should not be sign of a worry. Key takeaways. Times like this reiterate the importance of risk management. It is advised to have a good mix of diversified stocks and some liquid assets like cash and gold in the portfolio. The second quarter earning, starting with frontline IT companies, will set the tone of the market in the next few days. Many stocks will start to form a base and continue their upward trajectory. Traders should focus on pockets of strength and stay very selective for the time being. That's all for today. Wishing you a great trading week ahead. Thank you.